Welcome everyone, my name is Agostino. I'm super excited here today to discuss an important topic for real estate investors, capitalization rates, or also known as cap rates. So whether you're new to real estate investing or have been doing it for years, understanding cap rates is crucial. It helps investors analyze potential deals and determine if it's priced correctly. Now, it also gives you insight to the potential risks and a general understanding of the returns of an investment, okay? So, and we're gonna get into more about, especially when it comes to risk, what it's a good level of understanding of how risk works. So in this webinar, we're gonna cover everything you need to know about cap rates from the perspective of a limited partner, or also known as a passive investor, okay? So I'll explain what cap rates are, how they're calculated, and how to interpret them. So we're also going to discuss the relationship between cap rates and investment returns, all right? So my goal is for you to walk away with clarity on this metric so you can make well-informed decisions as you start looking at opportunities, all right? So now before I get into that, I'll tell you a little bit about my background, all right? So I started doing real estate close to 20 years ago, and it was all about single family and small multifamily. That's what I was doing. And I would say later on, after I grew that part of the business, I stopped for a little bit, but then I re-kicked off everything with a huge focus on commercial deals, right? So I started doing larger deals. And since then, we started really expanding the business. So now we have 4 lines of business that we do. The first is B and C type of assets that we acquire. And we own them, we run them, and we create good environments and good communities for people to live in. The second is our development business. This includes adaptive reuse of office buildings and ground up development, specifically in urban infill. So we're looking for land inside of a city, right? And where we can build stuff. The third is our blind pool fund. What we do is we acquire Dollar General, Dollar Tree, VC animal hospitals, things like that. And it has a corporate guarantee or a franchise guarantee. It's good, solid returns, monthly returns, which are especially critical these days, and you still get all the benefits of real estate. And the fourth line of business is our media and education business, where we help other people get into the business, right? So it's been a long road. The cool thing is that I've been through market cycles, and we help other people get into the game and really learn from the mistakes and from the things that I've seen in the past as well to help other people succeed in the business too. So we actually have 2 masterminds that we run. Both are 50 weeks in length. It's a weekly mastermind where we walk you through how to underwrite a deal, how to pick the market, how to present yourself, building credibility, raising money, the whole 9 yards. We talk about stuff like that. So if you're interested, check out the multifamilyadvantage.com, themultifamilyadvantage.com. Okay, check that out. And if you're interested, go ahead and sign up, right? We'll reach out to you. So let's get into it, okay? First, what is a cap rate? Let's start with the basics of what a cap rate or a capitalization rate is. The cap rate is a formula that measures the rate of return on an investment, usually real estate, that's based on income that it generates. So it calculates the ratio between the property's net operating income, okay, which is the NOI, which is the annual income left over after the expenses are paid, and the property's market value or the purchase price, okay? So in simple terms, the cap rate tells you how much income you'll earn each year relative to the value of the property. And it's expressed as a percentage. So for example, if a property is valued at $1 million and it generates $100,000 in net operating income per year, so it's NOI, right? $100,000 of NOI, the cap rate would be 10%, right? So it's 100,000 divided by a million is 0.10, so 10%, right? So the higher the cap rate, the better the return on the investment is. There's more to it than that, All right. We'll talk more about interpreting the cap rates here in a second. All right. So before I do that, let's talk about what affects a cap rate. All right. So that's what I just described is what a cap rate is. So let's talk about the factors that affect a cap rate. So the main things that influence a cap rate is the location, okay? And these rates vary significantly between various markets. So major factors are involved here. It could be supply and demand dynamics, market fundamentals, growth potential, a whole bunch of different things about a market will drive the overall value of it. So here's an example, right? Cap rates tend to be lower in competitive markets like New York and Los Angeles, okay? Why? Because there's so much density there, people moving in and out, and people always looking for a place to live. In the case of multifamily anyway, it's going to impact the overall valuation, right? There is also the property type. The property type will have an impact on the valuation, the NOI, and the cap rate, right? So different property types have different risk and return profiles. So multifamily and industrial properties often have lower cap rates than, say, hotels or retail, right? Why is that? Because hotel and retail, there's an actual business that people run on a regular basis, right? Not saying that multifamily and industrial don't, right? But with hotels and retail, it's a little more transitory, where with industrial and multifamily, there's a lot of leases or some sort of legal contract involved between the tenant or tenants that are in the asset versus a hotel and retail where there's a sales component, right? So it's two different ways of looking at things, right? Both are measured in some sort of cap rate, and they have a level of risk between them, right? Financing also is a big deal here too. So if a property has very low leverage that can support a lower cap rate versus a highly leveraged asset too. There's also the condition or the quality of the asset. So a Class A trophy asset commands a lower cap rate than, say, a B or a C class property that needs renovation. So very quickly, an A class asset, brand new asset, really, really pretty, nice and shiny. A C class asset is primarily workforce housing, might be built 30, 40 years ago, right? Or reconditioned, or requires a great deal of maintenance. And B is somewhere here in the middle, right? So if you're thinking about the avatar, the people that's living here, C is going to be your workforce housing, B is going to be your typical middle manager, and A class is going to be your high income earners. Think of it like that as your avatar and who lives in these three various assets, okay? That's who lives there. What else matters here? The expenses. Lower operating expenses means higher NOI and a higher cap rate. Newer properties typically have lower expenses, okay, because everything's fairly new. Older properties typically have higher expenses because it needs a lot more maintenance, okay? What else matters? Occupancy rates, okay? Properties with stable, high occupancy have lower risk and lower cap rates. So, in summary, the major factors that affect the property's cap rate all relate to risk. The risk the investor can expect from that asset, okay? Lower risk is a lower cap rate, which also means a lower return, right? So if you're taking that 10% cap rate, it's generally a higher amount of risk. So when you're looking on LoopNet, and someone leads with, "Oh my God, it's a 13% cap rate. Look at how great it is." It's a high risk deal, right? It's not a low risk deal. It's a high risk deal. All right. That's what it means. So you have to make sure that the juice is worth the squeeze. All right. Is it worth doing that deal? That's what you have to figure out. All right. So there's 5 types of cap rates here. All right. 5 types. There are several types of cap rates that are used in commercial real estate analytics, all right, and analysis. The main ones are the ones that the limited partner needs to know. So number 1 is the going-in cap rate, all right? This is the cap rate at acquisition. It's based on the property's current NOI. Second, the pro forma cap rate, based on the projected NOI after the value-add improvements. And again, the pro forma I like to look at is from the people that are putting the deal together, not from the broker, It's from the deal the people putting the deal together. That's the true one, because they're the ones who are going to do the work, to do the heavy lift to make it better, right? It's usually going to be based in reality as opposed to what the broker puts out there, okay? Third, the reversion cap rate. This is the estimated cap rate at which the asset could be sold when you exit the deal, okay? Fourth, the equity dividend rate. So this is the annual cash-on-cash return to investors that are based on distributed dividend income, okay? And then 5, there's a cash-on-cash return. This is the annual return calculated from cash flow before depreciation or refinancing proceeds, okay? This is usually what I like to harp on is cash on cash, because it's easier for people to understand how much cash are they putting in, how much cash they're getting out. It's a very simple metric too, right? So that's a good way of presenting it. If an investor's putting up $200,000 and they're expecting $400,000 to come out, it's a very easy metric to understand, right? But as a limited partner going in, pro forma and reversion cap rates help you understand the sponsor's underwriting assumption, and the equity the equity dividend rate and the cash on cash shows you the potential annual returns. All right, that's what those two things do. All right, those two sets rather, right, of the 5. So the cap rates and the required returns. So there's an important relationship between cap rates and the investor required rates of return. Now, in short, a property's cap rate should be higher than the investor's required rate of return to make the deal economically feasible, right? So investors have certain return thresholds that they want to meet generally, right, to make a deal worthwhile. And it has to be based on a lot of things, including their cost of capital, right? How much money does the money actually cost? And the risk level that they're stepping into, okay? This is typically called the discount rate. So if the cap rate is lower than the investor's required return, it means that it just can't achieve the needed return at the asset's current valuation. So the deal doesn't make any sense at that rate, right? So when you're looking at the potential deal as a limited partner, you want to see a cap rate premium over the typical required return for that asset class and for that market. So it gives you a nice margin of safety, right? So what that means, though, is that when you are looking at these various markets and you're looking at the various return profiles and the cap rates and the quality of the asset, all of them are going to be different. Doing a multifamily in New York versus doing a multifamily here in Cleveland, two very different return targets, very different cap rates, even very different debt, right? All of it matters, right? So it has to fit your return profile that you're looking for. With net lease, as an example, a little different, right? Net lease typically has a lower, I guess you can say, a cash on cash return, but it's extremely low risk, right? Very low risk. Why? Because we have a tenant that's in there, a corporate tenant, think of Dollar General, and they're in that deal, they're in that asset for an extended amount of time, and they guarantee they're going to cover the mortgage, or rather cover the rent, over that length of time, the entire time. And they always pay on time, which is great. So if I can tell you that on the third of every month that money shows up, then it's a lower risk of return, right? Or it's you're not worried about not getting the check, right? The Dollar Tree's not going out of business tomorrow. Family Dollar's not going out of business tomorrow. They're going to be around, and because they have a lease that says they're going to be around, there's very little concern. So it's a lower risk type of deal. So the point is that the different deals are going to tell you the level of risk and the type of return you're going to expect, right? It's a risk adjusted return. So let's talk about interpreting the cap rate. So we'll talk about especially when you're underwriting deals, right, as it relates to that. So you have higher versus lower cap rates. So in general, higher cap rates mean higher returns, but also means higher risk, okay? Lower cap rates mean lower returns and lower risk, all right? Then you have to also look at the comps, the comparables, okay? You have to compare a property's cap rate to others in the market to determine if it's high or low, right? How does it measure up? If you're looking at two deals in the same market, how does that measure up? What, and how does it compare, right? If you're looking at a 100-unit deal in one neighborhood, and you're looking at another 100-unit deal in a similar neighborhood or the same neighborhood, like how do the cap rates compare, right? All things being equal. You have to look at the reversion cap. Make sure the reversion cap rate is at least 50 basis points rather, higher than the going in cap rate. So this gives you a conservative number just in case the market changes the way it has recently, right? You want to make sure that you have some slush in there, right? You also have, like I said before, what's required, right? What is the cap rate that the sponsor, the person putting the deal together, they're projected to put out there, and does it sound reasonable, right? You're also looking at the cash flow. So don't rely on just the cap rate alone, all right? The cash flow is ultimately why we're doing this, all right? That's ultimately why all of us that get involved in a deal, myself included, is we're looking for that sweet, sweet, sweet cash flow. That's what we're doing, right? That's why we're doing this. So you want to make sure that the cash flow is still there. So don't get too hung up on the cap rate, so to speak. What does the cash flow projection look like, and when do you get yours? That's what you want to understand, all right? So use the cap rates as one tool when you're assessing the potential deal, but make sure you understand the rationale behind the sponsor's cap rate and assumption. I think that for many, many folks out there, especially over the last 2-3 years, they made crazy assumptions on cap rate. There were a lot of cap rate compression that was taking place now. We're seeing that come off these days in the market at large. But early on, there was a great reliance on the greater sucker theory, right? That means you had guys going down to Miami, buying stuff at a 3 cap or 4 cap with 3% debt, and then overpaying for it. They're paying, say, $350,000 a door, and the rents are $1,200 a month. I can assure you that deal does not cash flow, okay? Maybe if you put more money down, it might, but what they're relying on is a short-term hold and eventually offload it to some other sucker for $400,000 a door, right? That's not how we do deals. We don't do deals like that, all right? We rely on cash flow. We need to see cash flow going into the deal. That's what we're looking for, okay? So that's where we're building, and that's what we look for. So that other type of deal is a whole different type of thing. But the point is that if someone's doing those types of 3% cap, try to get more money for it down the road. That's all speculation, not the same thing, all right? So anyway, so really that's when it comes to doing these types of deals, okay, this is, it's cap rate is one of those things to understand as one of those metrics, okay? And understanding how they put together, how it works, what it is extremely important. Now, if you want to know more about how to put these types of deals together, go ahead, go to themultifamilyadvantage.com. We go into detail about how to get into small multifamily, especially. Now, if you're watching this video, chances are you're probably looking to do some big multifamily. You may be looking at doing syndication, maybe looking at raising money, okay, and putting together a whole business plan. Check out multifamilyaccelerator.com, okay, where we basically help you build your business in a 50-week mastermind. It's huge, all right? We give you all the tools you need to become successful, all right? So go ahead and check that out. And if you made it this far, if you're watching the replay on YouTube, okay, do me a favor, do me a solid here. Hit that subscribe button, all right? Throw up some love, give me a like, all right? If you've made it this far, hopefully I brought some value to you, right? It'd mean the world to me, because it helps us out, helps the channel, and helps the team here with putting out more great content for you. Okay, so hope you feel confident in analyzing cap rates. Again, if this, I know there's a lot of stuff here that we talked about, right? Feel free to ask questions, leave them in the comments. All right, if you're watching the replay here, if you're watching this live, leave them in the side here. We'll get to it. All right, happy to clarify anything that we discussed today. So thank you so much for your time. I greatly appreciate it. All right, hope you got a lot out of this. I will see you on the next one. All right, take care.